The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to today's webinar, Volatility and Investing in Today's Market, presented by our sponsor, Heffernan. We're so happy you can join us. My name is Amanda Ramatar, and I will be your moderator today, and I will also be monitoring questions you may have during the session. Before we open up the session, let's review a couple of key items. All of the webinar materials we discuss can be found at the URL currently showing on your screen. I will be sharing this URL in a follow-up email, so don't feel like you need to write it down right now. If you have trouble with your internet connection during the webinar, we recommend leaving the presentation and logging back in. We do not control the audio. Your devices control the audio. So if you have audio difficulties, try adjusting the volume settings on your device. If a telephone line goes dead during the call, hang up and call back again to the same number. If all lines go dead, watch the on-screen chat box for an alternative call-in number. Feel free to ask questions or provide feedback using the chat box or questions box during the webinar. If you are using a tablet, you may need to tap on the screen for the options bar to appear, then you can select the appropriate option. We may not respond immediately, but we will work your questions or feedback into the presentation. If we can't get to your comment or question during the session, we will be online afterwards to respond, or we may follow up in an email if we run completely out of time. You may also email us at moderator@aspenrmg.com for up to 48 hours after the webinar. This will be a 1-hour presentation. Questions and comments are very much encouraged throughout, and the presenters will be answering questions at the end. And lastly, we have a number of upcoming webinars covering a variety of topics, including those listed at the Heffernan webinar website. In addition, we are offering the mandatory Preventing Harassment training in English on June 20th this year. With that, let's begin today's webinar, Volatility and Investing in Today's Market. Our presenter today is Anthony Calameni. Anthony is a Vice President at Heffernan Financial Services. He is a knowledgeable, experienced advisor who has been servicing his clients for over 20 years. Anthony specializes in retirement income planning strategies for working professionals, retirees, and business owners, and has a direct responsibility for a number of the firm's clients. He focuses on providing his clients with a goals-based investment plan to help them work toward achieving their long and short-term investment goals. Anthony believes in ensuring his clients have a plan in place to help them save for retirement to support their lifestyle and goals. Anthony works closely with his clients to help them understand the financial markets, create a personalized investment plan on their risk comfort zone, and recommends ongoing adjustments to the plan in response to market and lifestyle changes. His academic credentials include a Bachelor of Business Administration degree in Sales and Business Marketing from Western Michigan University. He also holds Series 7 and 66 securities registrations with LPL Financial, as well as his California state life and health insurance licenses. In his role at the firm, he serves individual and corporate clients of Heffernan to help guide them to their goals with their investment and retirement planning needs, and to help educate them on planning strategies and investment options. Thank you for being with us today, Anthony.
Thank you very much for the introduction, and thank you for having me. Let's go ahead and get started here. All right. Well, good morning, everyone, and thank you for attending. Again, my name is Anthony Calameni. I'm a financial advisor with Heffernan Financial Services, and I appreciate you taking the time out of your day today to go through this informative presentation on the market, because it's always top of mind for us and always enjoy learning a little bit more. So we're going to cover a number of different items when it comes to volatility. We want to make sure that you're not just invested, that you thrive in the current market. And we want to make sure that we're building through multiple market cycles and different types of crises that will come up. It's my hope that you'll come out of this webinar feeling like you understand how the market behaves and you know what to expect from it, so you can prepare for every possible scenario. We're going to explain how market volatility works, and we're going to spend some time talking about how we as humans and our brains tend to react to volatile markets. This is based on research from behavioral scientists who've studied our brain and which parts of it are activated when money's involved. We'll also talk about how we plan for volatility and how we partner with you to help your plan stay on track to the best of our ability, no matter what the markets are doing. So let's go ahead and get started. So first, let's talk about why volatility exists and how it acts. If we're walking along and this bear jumped into your path, what would you do? Most of us would want to run. I certainly would, but contrary to our natural instincts, wilderness guides say to lay down on the ground and play dead. There's no way to outrun, outswim, or outclimb a bear. So your best bet is to face it down or by lying on the ground. The same is somewhat true for the bear markets. By fleeing, you might only make the situation worse, but by facing it down, you'll be well prepared to make it through. Now, something I want to acknowledge up front is that investing is stressful. While the saying goes that money can't buy you everything, we all know that it's not about what you can buy, it's what money represents. While it may represent something different for each of us, I would think we all can agree that no matter who we are, money represents our future, how much flexibility we have, how many choices we have, and how much freedom we have. Flexibility, choice, and freedom to live our lives the way we want. With all of that tied up in our money, it's a wonder any of us are willing to put our money into an investment account. So why do we? We all know that just stuffing it under our mattress or into a hole in our backyard means it will lose worth over time due to inflation. That's just the nature of the world we live in. And now, with very few pensions left and longer lifespans, we have to fund our own lives for what could be many years to come. The only true way to do that these days is by putting it into the stock market. And that's why we're all here today. We invest our money to help manage against the risk of inflation, so our money doesn't lose value, and to potentially grow funds to help us fund our future retirement or other future goals. We also know that the market isn't just going to keep going up all the time, unfortunately. I wish it were, but actually, sell-offs are needed in order for us to make money. So let's talk about that. You've likely heard the term before, but what is volatility really? Simply put, it's changing stock prices. Sometimes they can change wildly from day to day or even in a single day. For example, one company's stock can start off the day at $5 a share and end the day at $10 a share. Or worse, it can start at $10 a day or $10 a share and end at $5 a share. When you're invested in multiple stocks, which is what mutual funds or exchange traded funds allow you to do, this can be unnerving when you see your fund losing value throughout a day or week. However, this is one way you and other investors make money, so it's necessary. For example, let's say you buy a stock at $1 a share. Over the course of a month, it goes up to $10 a share. But then the next month it plummets down to 50 cents. You get nervous, right? But if you're continually investing, you get to buy more shares at 50 cents instead of your original price. Then over the course of several months, the stock goes up to $5 a share. You've made money. Even though the price went up and down wildly, in the end, you came out ahead. This example reflects an investment technique called dollar cost averaging, which means you purchase a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. similar to like a 401k or 403b. As a result, you end up purchasing more shares when prices are low and fewer shares when prices are high. When implementing this strategy, it's important to consider your ability to continue purchasing through fluctuating price levels. Now, keep in mind, this strategy does not assure a profit and does not protect against loss in declining markets. When it's happening, volatility can make us all nervous. But it's important to remember that it's common and has happened all throughout history. It's also often unpredictable, meaning trying to buy and sell at specific times to take advantage of price swings is very difficult, if not impossible, to do. Simply put, volatility happens because investors try to hedge their bets. They want the best deal. They want to make sure they want to make as much money as possible. If it looks like stock prices might decrease, investors sell to try to make a profit at the top of the market. If things are looking good and the future appears bright, investors buy. They think their investment will only go up in value. Investors in the market they invest in prefer stability. Stability means things are likely to continue as they have been. When there's instability, investors get nervous and sell. They think things aren't likely to get better, so they try to get the most money by selling today. As soon as investors anticipate things are going to get better, they buy. They think a deal is on the horizon. This tends to happen when there's clarity around the economic environment in the future. So let's talk a little bit more about what causes this, just to help understand. There are several items up on the screen, but really anything can cause volatility. Some things make sense. For example, if you're looking at individual companies, their financial performance impacts how much they're worth, and thus how their stock prices. If a company doesn't make as much money as they expected, for example, their stock will go down in price. That type of price change makes sense, but a lot of times stock prices will change simply because of how investors are feeling about life. If they're nervous about life in the future, they may start selling a lot of stock shares, making the prices go down. If they're feeling good about life, they may start buying a lot of shares, making the prices go up. Anything and everything can impact how investors feel about life. Politics or the news, for example. People are unpredictable, which is why the stock market is unpredictable. So what do we do with volatility? Well, first we need to understand how volatility has occurred over history. If you understand how the markets have acted in the past, it can help put volatility into perspective. The markets have gotten very volatile with major upswings and downswings over the past couple of years, but in the end, they've historically trended upward. Secondly, it's important to remember that volatility is a common event in long-term investing. When volatility happens, remember that it's to be expected and could be an opportunity for you. Thirdly, have a plan for both your investments, which I can help you with, and how you're going to handle volatility when it happens. Prepare yourself to see it in the markets and remind yourself what your plan is. Fourth, have a diversified strategy, which can help you weather volatility. We'll take a look at a bit more of this here in a minute. So let's understand the markets. This chart shows how markets have performed historically. Specifically, this is the S&P going back to 1928. Despite always having volatility over the long term, they've trended upward. There have been times when the market is trending down, and without those times, there wouldn't be opportunities to purchase low-priced stocks and potentially make money in the future. When stock prices are low, investors have, in the past, seen the opportunity and purchased the stock, which has driven the price up, resulting in an upward trending market. Over time, prices can get too high and investors sell, which may start the cycle all over again. While this cycle could change in the future, it makes sense that it would continue, because there will likely always be someone who sees an opportunity by investing in businesses by purchasing stock that's very low cost. And when purchases happen, it helps the markets go up. Now, of course, it's always important to remember that everything that we've looked at is showing how the markets performed in the past. We can't know or guarantee what the markets are going to do going in the future. However, we know we can learn from history and apply it to strategies today. And again, when you look at this chart, you can see the percentage of time the S&P index rose over the rolling time periods. So a 1 year time frame still has just over a 75% chance of a positive return. As you go into 3 years, 5 years, 10 years, you can see those probabilities go up. At 15 and 20 years, we're at 100%. 15 rolling period, 20-year rolling period, going back to 1928, 100% positive returns. Now, throughout history, the market has faced extreme crashes and dips, but it's always recovered. On the screen are just some of the events that caused a major market dip. As we said, what's happened in the past doesn't mean the future will act the same, but it's a good indication. Now, because we're human, when things are looking bad, we want to get out. But remember what we said at the beginning about the bear. How do you deal with the bear? Stay the course. By fleeing the market when things start to get scary, you could miss out on the best days of the market. Missing just the 5 best days over the past 20 years would have reduced your investment returns by 2/3. And that's a common experience when you look at market history. You can see, even if you missed 1 day, it drops your annualized growth rate. But missing 20 days, that's a significant difference. Now, how do we know when those days are? Well, what's interesting is that markets tend to have the best days and worst days close together. This happened in 2008, and it happened in 2020 during COVID. This is why timing the market is so difficult. You just can't be sure when markets will turn around. Just when you think things are going to get worse, that's when they could turn around and start trending up. Yes, there are forecasters out there who attempt to figure out when the market is at the bottom and at the top, but very few have gotten this right consistently, and none have always gotten it right. Think about the recent market volatility. We had some terrible days, terrible year, terrible months, and many of us thought things would just get worse and worse. But then we had a couple of major upswings at times when the news still wasn't looking great. Why? Investors saw opportunity. We're not at the lows that we saw last year. We're not at the lows that we saw in 2020. There have been positive moves to the upside. Now, I expect the market to continue this volatile movement because it's unpredictable. I wouldn't have been surprised if the market continued to decline this year. And just like this chart, the worst day happened very close to the most recent best day. So we will see some bad days, and then we should see some good days shortly thereafter. Now that you've seen how markets react, how best days are worst days are often very close together, making the markets difficult to predict, you can see how going against what everyone else is doing could potentially be the better strategy. We all know the old adage is to buy low and sell high. But as a group, most investors do just the opposite of this. They buy when stocks are on the way up and sell when they're on the way down. In general, throughout history, investors get nervous and sell out, often right before the market is taken off. So when the crowd is fleeing the markets, by going against the flow and staying invested, you could potentially do much better in the long run. So now that you understand a little bit how the markets tend to react and you know volatility is going to happen, how can we respond to it? Letting volatility motivate you to pull out of the markets when they're down can mean that you lock in losses. You don't have the benefit of a rebound. And now you have to determine when to reinvest or where to reinvest, which can be very difficult. Investors who get nervous and pull out of the market when prices are dropping usually end up losing money for all the reasons we just talked about. And on the screen, this proves it. S&P 500 index average return, almost 10%, but the average equity investor return is 5%. So the S&P is one of the stock market indexes. It's a group of stocks, and watching their prices can tell us a lot about how the markets are doing. Over time, the S&P 500 has trended up. This 9.96% return is an annualized return over the last 30 years. Now, a lot of investors invest in the group of S&P 500 stocks. However, the returns aren't matching that. And one reason is because investors often get nervous and pull out of the market. The end result is they lose out on returns. So you may want to have a strategy that plans for volatility and a mindset for how to handle volatility when it does happen. So the moral of the story is to stick to your plan and stay invested to weather volatility. The plan you create is based on your specific timeline and designed to account for market fluctuations. If you commit to stick to that plan and continue to invest on a regular schedule, you'll be well positioned to work towards your goals. Nothing is certain, but sticking to your plan over trying to time the market is an appropriate approach for most investors. So now that we've got in our history lesson, let's look at the science to understand how we all react when money's involved. Now, most of us probably think that because money is related to math, it involves the logical part of our brain. But scientists have found that the opposite is actually true. Money activates the emotional part of our brains, the amygdala, or as some call it, the lizard brain. The lizard brain is the one that simply reacts and responds to external stimulus without pausing to consider the facts. This happens to all of us. We can't help it. It's simply how our brains function. Now, the lizard brain activates the fight or flight response, and it does so immediately. It sees a threat and aims to mitigate it. So that means if you're losing money, our fight or flight response is automatically activated. Driven by emotion, we feel the need to do absolutely anything to prevent loss, even if, when removed from the situation, we might make different decisions. So what do your emotions drive you to do when it comes to investing? Well, most of us, if we see dollar signs, we want to buy. We feel a rush of excitement and possibility. But if we see loss happening, we want to sell. We feel a rush of fear of losing our future. And as we just discussed, both of those are in opposition to what we all know we should do. Our lizard brain does not help us make wise investment decisions. Now, something that's really exciting is that you can actually train your brain, pretty amazing. You can actually force it to go against its wiring. Think about creating a new habit. After you consciously choose to do something over and over again for several days, you'll eventually do it automatically. When you do this, you're actually creating new pathways in your brain, and you're actually changing your brain. Now, to do this, you have to activate the logical part of your brain, your prefrontal cortex. By using that part of your brain, you can train yourself to remove emotion from the equation. The easiest way for me to kind of compare this is if we see a stock price going down, our initial reaction is everything's bad, the stock's going to go to zero, I have to sell it. Well, that's obviously an emotional response, not a logical one. But if you go to, a shopping, a store like Target, and you see a product that you like that's 50% off or 20% off, you're more likely going to buy more of it because it's on sale, because that's a logical decision. So that's what you want to start thinking about when it comes to market volatility. Take the emotion out and focus on the logical part. Now, we want to use that part of our brain, the logical part of our brain, to plan ahead on how we will react. So we want to recognize how your brain wants you to react and decide that you will go against it. For example, if you know that your emotional brain will drive you to want to sell out of your plan, acknowledge this and decide ahead of time that you will not do it. But that's hard to do. It's going against our ancient wiring. The way to do this is to have an accountability partner who you empower to help you stick to your strategy. Know that there's going to be volatility, put together a plan, make decisions logically, not emotionally. And if you need a partner to help, find a partner. So now that you know how the markets react, and now how your brain wants you to react, let's discuss how we help you plan ahead of time for volatility so that you can train yourself to stay the course. First, remember that a strategy is based on you, your goals and needs, whatever they may be. Everyone on this call is going to have a different goal, a different timeline, and a different risk tolerance. Your strategy is based on those items. Now, we aim to reach those goals, but we're not going to focus on specific market performance because that's the uncertain. This is really important to keep in mind because others out there may simply invest to get the most money possible, but that's not the best approach in our mind. That's because reaching for the most may not be necessary and introduces unnecessary risks. We try to reach for what you need. First, work to determine what your specific goal is. For example, if you're primarily investing for retirement, do you have a specific number in mind for retirement? Are you already in retirement and want to generate income? Once we know what your primary and possibly secondary investment goals are, we'll figure out your risk tolerance. Now, part of this involves your investment timeline. If it's far out, you have more ability to be aggressive because you have more time to recover from falling markets. but it also may just come down to how you feel about risk. I have some investors who would prefer to bring in less money over time if it means they experience less loss in the short term. They're very conservative. Now, based on your time horizon, goals, and risk tolerance, we want to select a primary investment objective. That is what your overall portfolio will strive to achieve. We also invest for your risk tolerance. We want you to feel comfortable with the amount of risk you're taking in your portfolio because nothing is certain. Now, returns are the gains or losses from a security in a particular period, usually quoted as a percentage. And the shorter the time frame, the more probability of volatility. The longer the time frame, more time for you to recoup any downturns in the market. Now, risk is the chance that an investment's actual return will be different than what you expected, and means you have the potential to lose some of your investment. Look at last year. Nobody had an expectation that the market was going to drop 20% or the bond market was going to be down 15%, but they did. That was the risk. Now, low levels of uncertainty or low risk are associated with lower potential returns. I can put my money in a money market, not going to earn very much, but I'm also not going to lose much. High levels of uncertainty are associated with high potential returns, right? Investing in tech companies or crypto, right? The risk return trade-off is the balance between the desire for the lowest possible risk and the highest possible return. Now, to review, diversification of your assets, your investment strategy means you have different types of investments in your portfolio. Investments from different asset classes do not perform the same during differing market environments. For example, stocks tend to do well when interest rates are low, whereas bonds do well when interest rates are high. But that's just one example. There are many different investment types and market environments. Since no type of investment always performs well, by combining the different types of investments, they can compensate for each other. When one is doing poorly, another may offset it by doing well, and vice versa. The result can be a portfolio that may have less drastic price changes, so diversification can never completely erase volatility, but it can help manage it. So now that you know how to build your unique strategy, it's important to understand how to plan for and anticipate market volatility. Your strategy fits you, your goals, risk tolerance, and timeline. And the strategy should be designed to behave a certain way to align with those goals. It will track to specific benchmarks, not necessarily the market index that you see in the news. If you're invested in 60% stocks and 40% bonds, well, only 60% of your portfolio is tracking to maybe the S&P 500 index, not 100%. Now, while your strategy will be designed to weather a variety of market environments, it will still experience dips and spikes. Just how big those dips and spikes will depend on your risk comfort level. Now, what this all means, by using an example, let's say you're very conservative and primarily seeking income as your objective. A strategy that aims to trend up very slowly and have fewer dips and spikes, so to a steady increase, you may not have large gains, but you should have fewer losses. On the other hand, let's say you're young, very aggressive, seeking gains, a strategy that aims to bring in high returns, but it will also mean you'll see larger losses in the short term if the market is down. We anticipate and plan for volatility in your portfolio, but it's always helpful to keep in mind that your portfolio is driving for and what your time frame is. Keep in mind that no strategy assures success or protects against losses. There's always risk when it comes to investing. You will want to continually review your strategy annually and make adjustments if your strategy isn't doing what it's supposed to do. Now, that doesn't mean your strategy is doing better than the markets. We're making sure your strategy is tracking with its stated goals. For example, let's say your strategy is designed to slowly trend up. It doesn't mean that it won't go down. It just means it shouldn't be down as low. If it is down as low and is consistently, it might be time to make a change to that strategy. On the other hand, if the market is soaring, this type of strategy will certainly go up, but it won't go up as high as the markets. So it's important to understand your strategy, what it's trying to do, and anticipate how it should react when we experience volatility. Now, when volatility does hit, if you don't feel comfortable with how your strategy is performing, it might be time to review your goals and risk tolerance. It may mean that you aren't as aggressive as you thought. You can always reach out to us if you have concerns, and we can take another look at your goals and feelings about risk, or work with your partners. But in the end, our goal is to have a strategy that you're comfortable with and helps you work towards your goals. Now, I know the last couple of years, really beginning of COVID, the market has been challenging. There's more investors in the marketplace. There's more news. Everything is more accessible. And there's a lot of noise out there. And the key is to make sure that you have good information when making these financial decisions, that you're making it logically and not emotionally. So we're here to help. We're here to help you through whatever you need, because it's times like these where I really feel there's a lot of value in what we do, because we're able to look at it from a logical perspective, because we've been here before, and make sure that your plan is tied to your strategy, your investment objective. So our job is to help you with that. So even when everything else in the world seems to be going crazy, we want to make sure that you have a plan that's appropriate to you, help you stick with it, so that you can eventually reach your objective. Now, we covered a lot of information in about 40 minutes. And I think the important part about this is, again, making sure that you have a plan, that you're just not investing blindly, that you know that the market just can't go up, but it also is not always going to go down. There's going to be opportunities, and you want to be invested to take those options, take those opportunities for your benefit. Now, my contact information is listed here. Obviously, a recording and presentation will be shared, but feel free to connect. If you have questions, we have the chat feature, we have the question feature. Go ahead and type them in, and I'll do my best to address it. But I really hope that you were able to listen to today and walk away feeling a little bit more empowered with understanding how the markets work and how you can protect yourself from it. That we can earn when the market goes up and try to protect or at least work through when the market goes down. So I hope this was informative. I hope this was helpful. I hope you feel better about your plan going forward than when the call started. So feel free to connect, but we'll all end the formalized presentation here and then open it up for questions. So thank you, everyone, and I look forward to answering any questions that you may have today.
Awesome, thank you, Anthony. We don't have any questions that have come in just yet. That doesn't mean they won't trickle in, though. If there is anyone who thinks of a question later, do know that you can send it to me via email, and I will forward it to Anthony. And you know, if there's anything that pops up for you. Otherwise, at this point, I think we're just going to wrap it up, and I'll say thank you to everyone for attending today's webinar presented by Heffernan. We will send information by email with instructions on how to access a copy of the presentation on our website. Thank you, Anthony, for your time and expertise today. We hope all the attendees found today's webinar to be a valuable use of time. Please be sure to join us on March 7th for our webinar called Future of HR Automated Workforce. Thank you and have a safe day, everyone.